Imagine this: you've spent the last 6 months studying the charts. You've watched hundreds of hours of tutorials. You understand support and resistance, you've mastered moving averages, and you've backtested a strategy until your eyes burned. On paper, it works. But when you sit down in front of the live charts, something goes wrong. A trade moves against you by a few pips, panic sets in, and you close it early. Or maybe you get stopped out, feel a sudden rush of anger, and immediately double your position size to get your money back. By Friday afternoon, your account is down, and you're left staring at the screen, completely exhausted, wondering what is wrong with you. Here is the uncomfortable reality that no one on social media wants to admit. The failure rate in retail Forex trading is not actually 90%. According to verified broker data and regulatory studies, it is closer to 95 to 97%. But here is the twist: thousands of traders learned the exact same strategies from the exact same books. They use the same indicators, watch the same economic calendars, and trade the same currency pairs. If the strategy was the problem, everyone would fail equally, but they don't. The variable that separates the 3% who pull consistent payouts from the 97% who blow their accounts is not what they know. It is how their brain reacts to financial risk under pressure. Almost every trader begins their journey looking for the Holy Grail. You believe that somewhere out there, hidden in a private Discord server or a mathematical formula, exists a perfect trading system with a 90% win rate. You find a strategy online. Let's say it's based on MACD crossovers and price action. You try it. The first 3 trades are winners. You feel like a genius. You think, this is it. I've cracked the code. Then, the market conditions shift. You hit a losing streak, 3 losses in a row. Suddenly, the doubt creeps in. You think, the MACD is too slow. It's lagging. This strategy is broken. So, what do? You abandon it. You spend the next weekend searching for something new. This time, it's smart money concepts or order blocks. You try it, you hit another inevitable run of losses, and you abandon that too. This is the strategy hopping loop. What you don't realize is that you are confusing variance with failure. In probability, variance means that even a highly profitable system with a 60% win rate can easily experience 5, 6, or even 10 consecutive losses. It's simple math, but because you don't trust the math, you assume the system is broken. Every time you switch strategies, you reset your learning curve back to 0. You never give yourself the time to build the deep, instinctual market familiarity required to execute a system properly when things get tough. You are essentially a permanent beginner, and beginners lose money. Why do we do this? Why is it so incredibly hard to sit through a losing streak and stick to a plan? To understand that, we have to look inside your brain. Human beings did not evolve to trade. Evolutionarily speaking, our brains are wired for survival. For hundreds of thousands of years, survival meant avoiding threats and securing resources immediately. Your brain has two main decision-making centers, the prefrontal cortex and the amygdala. The prefrontal cortex is the logical, rational part of your brain. It's the part that builds your trading plan, calculates your risk-to-reward ratio, and tells you to place a stop-loss. The amygdala is the emotional, ancient threat detection center. It doesn't understand pips, leverage, or interest rates. It only understands survival. When you are in a live trade and the price begins to tick against you, your amygdala doesn't see a minor market fluctuation. It registers a threat to your resources. Your brain reacts to a losing trade the exact same way it would react to a predator in the wild, with a massive flood of stress hormones like cortisol and adrenaline. Your heart rate goes up, your breathing gets shallow. And most importantly, your prefrontal cortex, the logical part of your brain, literally begins to shut down. Under stress, your brain is hardwired to make quick, impulsive decisions to escape pain. This is why you move your stop-loss. This is why you close winners too early. Your survival instincts, which keep you alive in the physical world, are the exact patterns that destroy you in the financial markets. If you want to survive as a trader, you must learn to override your biology. But overriding biology is easier said than done, because when that stress response kicks in, it triggers a chain reaction of psychological traps. In the next part, we are going to look at the single most destructive emotional cycle in all of financial trading, revenge trading. We will dissect the exact moment a normal human being turns into a reckless gambler, and the chemical storm in your brain that makes it feel completely logical at the time. The neuroscience of a loss: cortisol, amygdala hijack, and revenge trading. Let's look at the single most destructive emotional cycle in all of financial trading: revenge trading. It is the moment a disciplined, rational trader turns into a reckless gambler, driven entirely by a chemical storm in the brain that makes self-destruction feel completely logical. It always starts with a single, normal loss. You placed a trade, you had a stop loss, and the market hit it. That's trading. But instead of accepting the cost of doing business, something inside you snaps. You feel a sudden surge of heat in your chest. A voice in your head says, "The market is wrong. That was a fake out. I need to get that money back right now." Within seconds, you enter another trade. This time, you don't wait for your setup. You don't calculate your position size. You just want to erase the negative balance on your screen. You double your lot size to make the recovery faster. And then, the market turns against you again. This is the amygdala hijack in its purest form. When you take a loss, your brain experiences a drop in dopamine and a massive spike in cortisol, the stress hormone. This cortisol spike temporarily impairs the prefrontal cortex, the logical area responsible for self-control and long-term planning. Your brain enters a literal state of threat response. It perceives the lost money not as a statistical probability, but as a physical injury. To heal this injury, your brain demands an immediate dopamine hit, which it tries to get by winning a trade. You are no longer trading the market. You are trading your own biological urge to stop feeling pain. This emotional reaction is amplified by a cognitive bias known as loss aversion. Psychologists have proven that the pain of losing is biochemically twice as powerful as the pleasure of winning. Losing $100 hurts twice as much as winning $100 feels good. Because human beings are wired to avoid pain at all costs, we will take massive, illogical risks just to avoid realizing a loss. Think about how this plays out on the charts. When a trade is in profit, you get nervous. You want to lock in that good feeling, so you close the trade early for a tiny win. But when a trade is in a loss, you do the exact opposite. You hold on to it. You move your stop loss further away, hoping and praying the market will turn around. You are willing to risk your entire account just to avoid admitting you were wrong. This is how a single, disciplined $20 loss turns into a catastrophic, account-clearing disaster by the end of the day. You didn't lose because of your strategy. You lost because you let a biological chemical reaction take the wheel. If you want to break this cycle, you have to understand that the market is completely indifferent to your feelings, your financial needs, and your ego. It is a giant machine reflecting the collective decisions of millions of participants. Trying to fight it or get revenge on it is like trying to yell at a hurricane to change direction. To step out of the 90% who fail, you have to learn how to transition from reacting to the market emotionally to observing your own reactions objectively. The disposition effect: why our brains are naturally wired to cut wins and hold losses. Let's talk about a psychological trap so deeply embedded in human nature that almost every single trader falls into it without even realizing it. It is called the disposition effect. In simple terms, the disposition effect is our natural tendency to sell winning assets too early, while holding on to losing assets for far too long. If you have ever watched a trade go 10 pips into profit and immediately closed it out of fear of losing it, only to watch the market trend in that direction for another 100 pips, you have experienced this firsthand. And if you have ever watched a trade go into a loss, bypassed your stop loss, and watched your account slowly bleed out because you just knew it would bounce back, you have experienced the other side of this exact same coin. This behavior makes absolutely no sense mathematically. To be a profitable trader over the long term, your average wins must be larger than your average losses. Even with the 50% win rate, if your wins are twice as big as your losses, you will make money. But the disposition effect forces you to do the exact opposite. It guarantees that your wins are tiny, and your losses are massive. Why do we do this? It comes down to how our brains process pride and regret. When you close a winning trade, your brain gets an immediate rush of validation. You feel smart. You feel like you beat the market. Closing the trade locks in that feeling of being right, and your brain craves that certainty. If you leave the trade open, there is a chance the market could reverse and take that profit away, which would cause pain. To avoid that potential pain, you kill the trade early, settling for crumbs when you could have had the whole meal. With losing trades, the psychology flips. As long as a trade is still open, it is an unrealized loss. In your mind, you haven't actually lost the money yet. There is still hope. Admitting you were wrong and closing the trade for a loss requires you to accept regret. It forces you to face the pain of being wrong. To avoid that pain, you keep the trade open, hoping for a miracle, until the loss becomes so massive that the broker's margin call forces you out anyway. Professional traders do not look at trades as a test of their intelligence or their ego. They look at trades as business transactions. They understand that a loss is not a failure. It is simply the cost of doing business, like the rent a restaurant owner pays to keep the doors open. If you want to join the top 10%, you have to learn to embrace discomfort. You have to get comfortable with the feeling of leaving a winning trade alone, letting the market do its work, and resisting the urge to micromanage it. And you must learn to love your stop losses, accepting that a small, controlled loss today is the only thing standing between you and absolute financial ruin tomorrow. The silent killers: overleveraging, overtrading, and lack of capital. Up to this point, we have talked about the psychological battles inside your mind: the fear, the greed, the revenge. But now, we need to talk about how those emotions manifest in your actual execution. We need to talk about the three silent killers of trading accounts: overleveraging, overtrading, and lack of capital. These are the practical, mathematical traps that finish off the accounts that your emotions have already weakened. Let's start with the loudest of the silent killers: overleveraging. When you open a trading account, brokers offer you leverage, sometimes 50 to 1, sometimes 500 to 1. To an untrained mind, this looks like a cheat code. You think, if I only have a $500 account, but I use high leverage, I can control $50,000 and double my money by tomorrow morning. What you don't realize is that leverage is a double-edged sword that cuts deepest on the side of the retail trader. When you use high leverage, you reduce your survival space to almost zero. The market doesn't trend in a straight line, it breathes. It moves up and down in waves. When you are overleveraged, even a tiny, normal market fluctuation against your position can wipe out your entire account balance before the market ever has a chance to turn back in your favor. You might have been completely right about the ultimate direction of the trade, but because you risked too much on a single position, you were forced out of the market before you could prove it. Professional traders rarely risk more than 1 to 2% of their account balance on a single trade. If you are risking 10, 20, or 50%, you are not trading. You are playing roulette, and the house always wins. This leads directly into the second silent killer: overtrading. There is a common myth that to make more money, you must trade more often. You sit in front of the charts for 8 hours a day, clicking buy and sell buttons, trying to catch every single 5-pip move. But the market only presents high-probability setups a few times a day, sometimes only a few times a week. When you overtrade, you are forcing trades out of boredom, frustration, or impatience. You begin to see patterns that aren't actually there. Every click of the mouse costs you spread, commission, and mental energy. By the time a real, high-probability setup actually appears, you are either mentally exhausted, out of capital, or too emotionally drained to execute it. And finally, we must face the reality of undercapitalization. The dream of turning a $100 account into $1 million is a lie sold to you by influencers trying to sell courses. Can it be done, statistically? Yes, in the same way that someone occasionally wins the lottery. But as a business model, it is a mathematical guarantee of failure. When your account is too small, you are forced to over-leverage just to make a profit that feels worth your time. If you make a brilliant, highly disciplined 5% return on a $100 account, you've made $5. Your brain registers that $5 as a waste of time, so you abandon your risk management to try and make $50 instead. To survive in this game, you must treat trading as a business, not a get-rich-quick scheme. If you don't have the capital to trade a live account safely yet, you should be trading on a demo account or leveraging prop firms, focusing purely on perfecting your process. Because if you can't manage a small account with discipline, a larger account will only allow you to lose money faster. The professional blueprint: building the mindset of the 10%. Now that we have stripped away the illusions, analyzed the biological traps, and identified the silent killers of your capital, only one question remains. How do you cross the line? How do you transition from the 97% who lose, to the 3% who consistently pull profits out of the market? The answer is not a better indicator. The answer is a complete paradigm shift in how you view the nature of trading. To trade like a professional, you must learn to think in probabilities, not certainties. The amateur trader places a trade and desperately wants to be right. They feel a personal connection to the outcome of that single position. If it wins, they feel like a genius. If it loses, they feel like a failure. But a professional understands that any single trade has a completely random outcome. They know that even the best setup in the world can fail, and the worst setup can win due to random market noise. Professionals don't care about the outcome of one trade. They care about the outcome of the next 100 trades. They know that if they execute their edge with discipline 100 times, the law of large numbers will play out, the variance will smooth out, and they will walk away profitable. A single loss is nothing more than a minor, expected data point in a massive sequence. To build this professional blueprint, you must establish 3 non-negotiable pillars in your daily routine. First, you must have a hard, written trading plan. This plan must define exactly what your setup looks like, what time of day you trade, what your maximum daily loss limit is, and exactly when you will walk away from the screens. If you sit down at your desk without a written plan, you are letting your emotions dictate your decisions. You are playing defense, and the market will run right over you. Second, you must treat your trading journal like a sacred text. Most traders keep track of their entry and exit prices, but they never write down their emotional state. In your journal, write down how you felt before, during, and after the trade. Were you anxious? Were you bored? Did you enter because of fear of missing out? Over time, you will start to see patterns in your behavior. You will realize that your biggest losses don't come from market changes, but from specific emotional triggers. Once you identify those triggers, you can build rules to avoid them. And finally, you must redefine what success looks like. In the retail trading world, success is often portrayed as flashy cars, expensive watches, and doubling your account in a week. But in the real world of professional finance, success is incredibly boring. Success is consistency. Success is executing the exact same routine day after day, keeping your losses small, letting your winners run, and protecting your capital above all else. The painful truth is that the market will always find your psychological weaknesses and use them against you. If you are greedy, it will trap you with FOMO. If you are fearful, it will scare you out of winning trades. If you are proud, it will crush your ego until your account is empty. To survive, you must drop the ego, accept the math of variance, and commit to mastering yourself before you try to master the charts. The choice is yours. You can keep chasing the illusion of the perfect strategy with the 97%, or you can step back, build your discipline, and join the consistent few. The charts are waiting, but this time, sit down as a professional.